The subjective interpretation of markets can be seen from two different angles within any reliable trading strategy. There is the subjective interpretation of technical setups and sensitive market variables like the interpretation of price action and the power of the overall context. There is also the subjective interpretation of risk that all traders need to deal with when trading real money. We all have the same biases and we are run by the same software when it comes to dealing with economic decisions involving risk, probability, and time. However, our personalities vary greatly and the way we respond to these biases also varies significantly. Every trader is a unique individual with finely calibrated intuitions about the market and overall risk. That simply means we need to recognize these differences and work to extract the best out of them. That also means that the trader is a unique part of the trade plan, and if the trader doesn't learn how to deal with a certain level of subjectivity in the markets, no trading strategy will be able to produce good results no matter how good the strategy is. It is important to clarify why traders need some degree of subjectivity in their analysis. This happens because the financial markets, as we already pointed out in previous lectures, is a multivariate and multidimensional entity and it is virtually impossible to roll back the chain of causality of price movements completely. That's the central point of the subjective interpretation of markets and its practical necessity. As we already saw in previous lectures, the representation of the market in bidimensional price charts has the effect of dimensional loss, and that makes impossible to roll back the chain of causality of all market movements. Consequently, part of the trader's analysis must come from a subjective interpretation of price. This is arguably the most difficult thing about trading. Since the price charts provide limited information, traders need to develop a market intuition based on price nuances. A perfect example of that is observing the relationship between the candle body and the candle tails. A trader cannot see the complete chain of causality of what happens inside every candle, but by observing the visual relationship between candle body and tails, the trader can subjectively arrive at useful conclusions about what happened inside this particular candle. Subjectivity in the conceptual sense is how an individual installs his intuitions about a given subject. This is closely related to the limited conscious bandwidth of our analytical power and the overwhelming amount of information that can be derived from the charts. The presuppositions a trader must make about the market are larger than his conscious bandwidth because the market's chain of causality cannot be fully rolled back due to the dimensional loss of price charts. This is a rather uncomfortable idea to most traders because everybody is after a completely objective and mechanical way of trading that eliminates the uncertainty out of the process. It's important to notice that it is impossible to trade in that way because of the things we are exploring in this lecture. There is no comprehensive market analysis without some degree of subjectivity. Once again, that's the case because of the complexity of the markets plus the limited tools a trader possesses to derive meaningful information out of it. It's interesting to notice that a great deal of how the market looks like in a chart is due to the subjective interpretation of millions of traders around the world. The structure of price is formed by its objective representation in a price chart, which is the nominal price you see in your screen, and its subjective interpretation, which is the perceived value of that nominal price. One of the forces that drive the markets up and down is the discrepancy between the objective price and the subjective value of any given market. For example, if most traders in the market look at the nominal price and they subjectively assume this price is higher than their perceived value of the market, price tends to fall because these traders will feel like the market is overpriced and they will open sell positions. By the same token, if most traders in the market look at the nominal price and they subjectively assume this price is lower than their perceived value of the market, price tends to rise because these traders will feel like the market is underpriced, and they will open buy positions. The bottom line is that to achieve the necessary level of complexity to produce high-quality trades, a trader must use some degree of subjectivity to read the intentions behind the price bars. As you will learn later in the course, there are several ways of doing this by looking at the way price action behaves. In the next lecture, we are going to explore the principle of interdependence between the strategy dimensions.